Hello class, this is Dr. Fenton. In this video, we're going to cover Chapter 8 that talks about budgeting. Let's go to the next page. Now, why and how do organizations create budgets? One of the reasons that they create budgets will be, number one here, it helps communicate management's plans throughout the organization. So the more people that are involved in budgeting, then the more people that know what management wants from them and from the company. So it lets them communicate across levels within the corporation. Also, number two, budgets force managers to think about and plan for the future. And also number three, it's a means to allocate resources. Number four, look for potential bottlenecks. What this means is if you see that you're going to run out of raw materials you need for production in a certain month, you can plan ahead and then purchase extra materials so you will not have that shortage. The same way works with cash. If you see somewhere along during the year you're going to run out of cash, then you can plan on borrowing that money ahead of time. On down the pages here, I want to cover this one, choosing a budget period. Budgets can be for a year, a quarter, or a month. It's up to the company. In our examples we're going to cover in a few minutes, they're going to be for the quarter. So 4 quarters in a year, we're going to budget quarter by quarter. There is something also called a continuous or perpetual budget. And the example they talk about here is a 12-month budget that rolls forward 1 month as the current month is completed. So let's say for the year 2019, you had a budget from January through December, and you had one for every month. Well, when January ends, what you will do is add the next January 2020, to that budget. So your 12-month budget starts February 1st, 2019, and then will end at that point January 31st, 2020. Then as your February month ends, you will add February of the next year. So it's a continuous budget. Now the next page, we have a nice flow chart here, and this shows what we're going to be working through in the next several pages. Everything starts with the sales budget. Everything's based on it: production, your selling administrative cost, and so forth, your cash budget. They all relate to what you think you're going to have in sales for the period. Now we're going to prepare a sales budget, also a production budget, and the production budget relates to what you need to produce for that period and that year to meet your sales demands. So your sales people will decide, we think we can sell a certain quantity during the year. And again, everything stems off of it, especially your production. Your production budget will be based on the ending inventory you had from the previous period and the ending inventory you would like to have at the end of the current period. So we're going to see that in a few minutes. Once you decide how much you need to produce during the period, then we need to plan for and budget for materials, labor, and overhead. So we'll see that pop up in a few minutes. After you get these budgets complete and you get the selling administrative expense budget complete, then you can come down and prepare the cash budget. And to me, the cash budget is probably the most important of all these separate budgets. All of them are important, but to me this is the most important. Once you complete the cash budget, then that leads you to complete the income statement budget and the balance sheet budget. So what we're going to do for the next several minutes is go through each of these budgets step by step. Let's see, anything else down here? You can read this yourself. It just explains each budget and what it relates to. For example, the sales budget. You want to know, what are the budgeted unit sales? How many do you expect to sell during the coming accounting period? Then you'll need to know, what is our expected selling price per unit? And that's going to help you determine then what is your sales level for those budgets as we go through the year. So read this when you have time. Let's go to the next page. Here where things are going to get very detailed. So make sure you follow this video very closely and pay attention to where I'm gathering the numbers from and where they're going in the statements. Go ahead and read this as usual. And like I've said before in the other video, is this video, Cover the Material in the Chapter, is not a substitute for you reading the chapter carefully yourself. So make sure you read all the background information I'm sort of skipping over, because I want to go straight to the examples and point out what you need to know in the examples. So here we are with the beginning balance sheet. So this is December 31st, 2016, and we're going to see these numbers pop up in the various budgets in a few minutes, like the cash budget, the accounts receivable amount, like the cash amount, the accounts receivable balance, and so forth. So we'll see some of these same numbers. We're going to go through an entire set of budgets in this example, and then at the very end we'll have another ending December 31st, 2017 budget. So let's get started on these budgets. Now this page, or this schedule, excuse me there, this schedule shows a lot of material. All these assumptions we're going to be using in the budgets to follow. So when you need to, I'm not going to come back to this assumption sheet every time. I might do it once or twice. But when you need to, look in your book and go back to where we're looking at the various budgets like sales, production, direct materials, and so forth, and look at these assumptions. These are very important assumptions. So let's just look at the first one. Again, we have 4 quarters for the year. We expect to sell 10,000 units. These are units here, not dollars. 10,000 units in the first quarter, 30,000 second quarter, and then 40, and then 20. Our selling price per unit, per case in this situation, is $20. Now these two assumption items will help us with the cash flow. So this shows us that 70% of the sales we have in any one quarter will be collected in cash in that quarter. The remaining part, the other 30%, will be collected in cash in the following quarter. So we'll come back to this in a minute. This shows us in the production, we want to have in finished goods inventory 20% of the next quarter's expected sales. So when you end a certain quarter, like the first quarter, you want to have 20% of what you're going to need in finished goods that you plan to sell in the second quarter. And let's see, you get into the production area, pounds of sugar per case, 15 pounds, 20 cents a pound. And then we want to have in raw materials inventory 10% of the expected needs in the next quarter. This shows how much we pay for it each quarter. So this first 50% says whatever we purchase as to raw materials in a quarter, we pay half of that in that quarter. We'll pay the rest of the other half in the next quarter. Okay, I won't go through the rest of these, but again, go back to this example when you need to. Here's the sales budget. We just saw these quantities, these units, a minute ago. So each quarter totals $100,000. There's a selling price we just saw. And so this shows us that in quarter one, we expect to have sales of $200,000. 10,000 units, cases in this situation, times $20, so $200,000 will be our total sales. Here's where we use the amount we collect in cash, and this is going to help us for the cash budget. We expect in quarter number one to collect 70% of quarter one sales in cash. So $200,000 times 70% is $140,000. Now you might be thinking, where did this 90 come from? This was the accounts receivable from the previous year end. We're going to collect that this period. So in quarter one, here are the sales. And of these sales, we collect in cash $140,000. And we also, in quarter number one, collect the previous quarter's, last year's accounts receivable in this quarter. So we will collect $230,000 in the first quarter. In the second quarter, the pattern's the same. Units times unit price, $600,000 in sales. We triple sales. How much of these sales will we collect in this quarter? $600,000 times 70% will be $420,000. And we also collect 30% of the previous month's sales. So in quarter number two, we collect a total of $480,000, which is 70% of the current quarter's sales and 30% of the previous quarter's sales. And do that for the other 2 quarters. The pattern's the same. Bring it all the way across, all the totals. So this year we expect to have $2 million in sales. And from all the sales, we expect to collect $1,970,000. Now here's the production budget. We expect again to sell 10,000 units in the first quarter. We also would like to have 20% of the next quarter's expected sales on hand in finished goods at the end of quarter number 1. So to meet this total need, the total needs here, we need to have 16,000 units in this quarter. Because we expect to sell 10, we want to have 6 left over that we don't sell, so we need 16,000 units. Now, do we have to produce 16,000 units? No, because we have 2,000 units in beginning inventory. So we need to produce 14,000 units in quarter number 1. Let me run through that for quarter number 2. We expect to sell 30,000 units. We want to have 20% of the next quarter's sales on hand in beginning inventory. Ending inventory. So we need 38,000 units in quarter number 2. Again, ask the question, do we have to produce 38,000 units? The answer is no, because we have 6,000 units on hand in beginning inventory. That's what we planned for at the end of quarter number 1. This 6,000 drops into here. And then we need to produce 32,000 units in this quarter. So do the same thing, same pattern, and you can see how they tie together. This ending inventory, quarter 1, is quarter 2's beginning inventory. Quarter 2 ending is quarter 3's beginning. And do all this. Now to put this all together at the end, again we expect to sell 100,000 units. We want to have 3,000 finished goods units left over at the end of the year. So we need 103,000. Do we need to produce 103,000 during the year? No, because we had $2,000 in beginning inventory, or I should say 2,000 units in beginning inventory. So we need to produce 101,000 units. Here is the direct materials budget. We need to figure out how much materials do we need to purchase during each quarter. That'll be in units, and also how much will that cost us. And then the bottom part of the schedule will show us how do we pay for that. In which quarter do we pay for the materials purchased in a quarter. So look at the beginning. We need to have 14,000 cases. This 14,000 comes from schedule number 2. Let me scroll up a little bit for this one. Here's the 14,000. We're going to produce 14,000 cases, units. So produce 14,000. We need 15 units of raw materials per case. I think that was 15 pounds of sugar. And so we need 210,000 units of raw material. At the end of any quarter, we want to have in raw materials ending inventory 10% of the next quarter's needs, production needs. So 10% times 480,000 units gives us 48,000. Add that to the 210. We need to have 258,000 units of raw material in quarter number 1. Do we need to purchase that much? No, because we have 21,000 in beginning inventory. So we need to purchase 237,000 units of raw material. How much will this cost us? 20 cents a unit. This is a pound. And so $47,400 is how much we need to purchase in raw materials in quarter number 1. To follow this on down, when do we pay for this? If you remember, in the very first schedule we looked at, it said that for our materials purchases, we pay 50% in the quarter we purchase it, and pay 50% of that in the next quarter. Our suppliers give us, some extra time to pay for that. So pay half of it in the quarter of purchase, pay half the next quarter. Now where did the 25.8 come from? Go back to your balance sheet and you'll see that is in accounts payable. So I won't go through the rest of these, but that's the pattern that you go through. Find out what you need, what you need to buy, cost, and when you pay for it. Now let's look at direct labor. This is the direct labor budget. If we're going to produce, again, going back to the 14,000 in quarter number 1, 14,000 cases, and it takes 40% or 0.4 of an hour, 40% of an hour for a case, we need to have 5,600 direct labor hours for quarter number 1. So we need to hire enough people to provide 5,600 direct labor hours, and we pay at the rate of $15 per hour. So our labor cost in quarter 1 will be $84,000. Follow the same pattern for all the other quarters, and this gives it the total for the year. So this is the direct labor budget. Now the manufacturing overhead budget, this shows since overheads applied on based on direct labor hours, we go back to the previous budget where we had 5,600, and excuse me a second, let me show you where that's coming from. 5,600 hours. All these will come down to the next budget, so 5,600 is right here. And our rate for variable manufacturing overhead is $4 per hour. So we're planning on spending $22,400 for variable manufacturing overhead in quarter 1. We also expect to spend $60,600 in fixed overhead in quarter 1. So our total overhead will be $83,000. So that's the overhead budget in dollars. In total cost. What this lets us do is show how much cash that will actually cost us. So you know from accounting 1 that every expense is not a cash expense. So depreciation we're going to pull out of these numbers. Depreciation is a factory overhead expense cost, but is not cash outflow. So cash disbursements for overhead will be $68,000 in the first quarter. So again, the $83,000 is total manufacturing cost. But cash-wise in the first quarter, we only have to pay out $68,000 for overhead. Now we can put all this together. Our entire overhead is $404,000. Drop this down. Our budgeted direct labor hours, 40,400. So we have a predetermined factory overhead rate of $10. This is the finished goods inventory budget. Now how much does a case cost us? A case is a unit. Well, if we use 15 pounds, per case, per unit, and we pay 20 cents a pound, it's $3. If we only need 0.4 of an hour, and it's $15 per hour, the cost for labor will be $6, and overhead, 0.4 of an hour, direct labor hour, times the overhead rate we just computed, so $4 per hour overhead for each case. So each case, each unit here cost us $13. And the budget finished goods inventory, if that's going to be 3,000 units we want to have left over at the end of the period, and each unit cost us $13, then we want to have ending finished goods inventory at the end of the year of $39,000. So we'll see this number in the balance sheet in a few minutes. Let's get away from the production area for a minute. This is the selling and administrative expense budget. Nothing in this budget relates to production. You can see that we do go back and use sales. So that's why the sales budget is so important. Everything relies on the sales budget. We expect to sell these units. These numbers should look familiar to you as before. But we found out earlier in that very first schedule we looked at that the variable selling and administrative expense per case is $1.80. So take $1.80 times the number of cases we're going to sell. Here is the total variable and administrative expense for each quarter. The fixed expenses were given to us. They're all fixed, so it doesn't matter what level of activity where we are. It's the same each quarter. Add that up, and so our total fixed selling administrative expenses will be $99. Add that to the variable, and our total selling and administrative expenses, variable and fixed, will be $117 for quarter 1, $153 for quarter 2, and you can see the others. Again, we want to be able to prepare a cash budget, so we pull away from the administrative area the depreciation. The $10,000 each quarter, yes, are in these numbers. But to find how much cash we're going to pay, we pull those out. So the cash we pay for these expenses in each quarter, you can see as the very last number. So $107,000 in the first quarter. So in other words, the $117,000 will show up in the income statement, but the $107,000 shows up in the cash flow statement. Well, the cash budget, I should say, the cash budget. And here is the cash budget. Here we go. All right. Now in this one, this was the beginning cash balance from the beginning balance sheet. And then this shows you which schedule we've already prepared and where the numbers come from. If you go back, I won't scroll way up to the top, but if you go back to schedule number 1, you'll see that we determined that we are going to collect $230,000 in the first quarter from customers. So our total cash available is $272,500. And now we have to pay quite a bit of expenses. So from Schedule 3, we came up with this number, Schedules 4, 5, and 7, these other numbers. We also decided that we're going to purchase $50,000 in equipment. This doesn't come from a budget. You could have an equipment purchase budget, but we don't have one in this example. We expect to pay $8,000 in dividends. So all these are cash flow numbers. These are not necessarily total expenses. These are total cash outflow numbers. So during the first quarter, we expect to pay out $366,500 in cash. But look at this. We only expect to have $272,500 in cash. We need to pay out $366,500. We are $94,000 short of cash in the first quarter. Since we have identified this $94,000 in cash shortage, then we can plan ahead to borrow money. So you can see right here, we are going to borrow $130,000. Now, why $130,000? Let me find that down here. Here we go. If you read the other information in detail, we want to have at the end of any quarter at least $30,000 in the bank. That is our minimum cash balance we need to have. We've already seen we're going to be short $94,000 just on the numbers that we ran in the cash budget. So we're short $124,000 when you take into consideration without borrowing money, we would be $94,000 overdrawn in the checking account. Plus, we want to have $30,000. So really, we are short $124,000 of where we want to be at the end of the first quarter. We can borrow money, but we have to borrow money in $10,000 increments. So we're not going to borrow exactly $124,000. We have to borrow $130,000. So we have to borrow more than we actually need, but that's just the rule here. We borrow in $10,000 increments. So if we're short $124,000 in total, we have to borrow $130,000 to cover that. Let's go back to the schedule. Here we go. So here's the $130,000. Once we borrow this total financing, then we have $36,000 left over at the end of quarter number 1. So that's above the $30,000 minimum that we need to have. This is your expected ending cash balance, quarter number 1. Take that to the top of the next quarter. That's our expected beginning cash balance, quarter number 2. Go through the numbers just like we just talked about. You can see which schedules these cash flow numbers come from. And we expect to buy only $40,000 of equipment in quarter number 2. We still want to pay out $8,000 in dividends. That's all the way across. In quarter 2, we still run out of cash. Even though we borrowed $130,000 in quarter 1, took the beginning balance over here, we still are short $36,100 in cash just on what we take in and have and pay out. We need to borrow $70,000 to get that covered, and that gives us $33,900 into quarter number 2, and then just do that for each quarter. Here you can see we have $165,000 and $650 in cash excess in quarter number 3. We finally turned things around cash flow wise. We have plenty of cash. We don't need to borrow any. And the reason we're not paying this back is because when you read the detail of the information, it'll say we don't pay anything back until the very end of the year. So that's why we don't pay anything back here. No principal and no interest in quarter number 3. We have plenty of cash. Take this large balance here, go through the numbers, 263, and now we can pay back $200,000 that we borrowed and interest. If you go down through here in the reading, I'll let you do that on your own. You can find out how we compute the $21,900 in interest expense that we have to pay for. So we expect to end the year with $41,400 in cash. We started the year with $42,500. So this is the cash budget. The income statement. Pull numbers from all, from quite a few of the previous schedules. Schedule 1, expected sales. Go to schedules 1 and 6, and you'll find the cost of goods sold. Schedule 7, administrative costs, selling administrative. Interest expense we just computed in the cash budget. So there's your expected net income. So we can have a budgeted, again, this is a predicted future income statement based on all the other budgets we prepared. The next and final budget is the balance sheet. So again, putting all the numbers together from all the other budgets, here's the balance sheet. I'm going to point out just this one number here, 41.4. Where does this come from? We just computed it. Right here. 41.4 is our ending balance in the cash budget. So that's where that number is coming from. And so go back to all the other budgets. I won't keep scrolling up and down to show you where all those came from. And the A, B, C, and D are explained right here. So this helps explain. It tells you which schedule they come from. So go back and look at this in detail. Even retained earnings, they show you how retained earnings, the ending balance is computed. Here's the beginning balance, plus the income, less the dividends, and there's your ending retained earnings. And we come up with the budget balance sheet. So most of these budgets, not all, but most of these you'll do in your homework. So please go back and read this chapter in detail. This is not a substitute for you reading the chapter. So spend a lot of time with it. I know there's a lot of detailed information here. So good luck with your studies.